viewers. Would have loved to continue and give more time to this. Let me bring on board Arnab Banerjee, MD, CEO at CEAT, joining us in terms of giving us a sense as to how the numbers have played out with regard to Q4. Mr. Banerjee, great having you. Let me first start off by asking you how demand is shaping up for you. Can the kind of performance that you've clocked in FY26, especially Q4, a very strong performance, are you seeing that translate in FY27 as well? And is it across in terms of replacement versus OEM, or is it a particular space which is doing better than the other?
Good morning and happy to be back. Quarter four, we have had close to 20% of volume growth. Post GST, there have been a fillip to demand in the replacement market, as well as the OEMs, which are growing at a very rapid clip. In fact, we've not seen CV industry growing at such a fast clip for quite some time now. The demand outlook as of in quarter one looks pretty robust in replacement. And in OEM, it will moderate a little bit, but it's still pretty robust, high single digit to double digit kind of growth. In the international market, Middle East is disturbed, as we all know. However, it's a very large market. And as I keep saying that as we get more access into the key markets of Western Europe and US, we are hopeful that international business also will be brisk. However, there is one catch here. Demand moderation could happen as we keep passing on the prices because of unprecedented raw material cost hike to the extent of even 15%. The raw material cost is going to go up in quarter one to quarter four base. So that could lead to some moderation of demand going forward. But as we enter quarter one of FY27, demand situation looks very robust.
And that is exactly the thing that I wanted to pick up on, given that rubber prices and crude-linked inputs have started to move up again, Mr. Banerjee. Walk me through what kind of cost trajectory do you see in, say, the next quarter?
So quarter one, as I mentioned, raw material prices are going to go up in excess of 15% by the end of quarter one to the end of quarter four. So that's the kind of hike we expect in a span of 3 months, and it's very steep. So that's a challenge going forward into quarter one, because the price hikes that we are taking, for example, in replacement by end of April will be going up by 5%. In OEM, it is indexed, so the price hikes will come after a lag of 1 quarter. We will have low single-digit price hike in quarter one. In international business, we have taken massive price hikes, but the pass-through takes time because there's at least a 30-day order base in between. So the price hikes will be lagging and leading to margin compression going forward, and maybe moderation of demand by end of quarter one. As I mentioned, as we enter quarter one, the demand looks robust.
Could this lead to a meaningful margin pressure? Because you already have your numbers worked out. And how much of it is manageable within your current operating metrics?
Well, we always maintain that we want to have minimum variability of margins. And if you see the last 3 quarters, at least we have been around that 14% mark and slightly improving. Quarter four was very good at 14.6%. But going into quarter one, we do see significant possibility of margin compression in a span of 5 years, which is 20 quarters, because of the cyclicity of the industry, the nature of the industry. 3 to 4 quarters will always see a margin compression because of steep rise of raw material. We are headed into one such quarter in Q1. Because by just optimizing cost, we cannot make up the entire raw material cost hike of 15%. So price increases are happening, but as you understand, there's a lag.
So what is the actual basis point impact on your EBITDA margins per quarter with crude at 100 plus levels?
Well, we don't give exact guidance, but all I can say is that when you add up that 15% plus hike and a delay in the price hike, which is taking place. As I mentioned, 5% we have taken. Another 5% needs to be taken through May and June. There will be a margin pressure which is significant vis-a-vis quarter four.
And how do price hikes translate all through the current year? You'll likely pass that through. I know that it'll be a gradual pass through, but Is there something that you have in mind in terms of how the pass-through will play out?
Absolutely. So we have a clear roadmap for the pass-through in aftermarket. As I mentioned, we need a price increase of total about 10% starting March, April. We are at the halfway mark. We have implemented or are implementing about 5%, which is half of that. Another 5% will be implemented. We intend to take up the prices. In OEMs, it is indexed, so we'll get it with a lag of 3 months. And in international business also, we are expecting to execute the price hike with a lag of about maybe 1 to 2 months.
And with regard to international, any impact with regard to either demand or how trends are shaping up going into FY27, given that there's plenty of uncertainty, especially with regard to supply chain?
Yes, so international, there will be demand moderation as we implement the price hikes, no doubts about that. But as I mentioned, it's a vast market and our turnover is not based on one geography. We are equally spread in Southeast Asia, Middle East. Middle East will be down, of course. Europe, Latin America, as well as US. Out of that, Europe and Latin America business, we have had some good success in channel accessibility. So we expect growth in those markets. We expect growth in Southeast Asia market. So we expect international business volume-wise to be pretty robust in quarter one.
And with regard to CAMSO, what's the kind of immediate short-term guidance or metrics that you're looking to achieve?
So CAMSO, as you understand, we are still under the transition phase, which means the sales to the customer is being handled by Michelin. And we are going to gradually take over a significant part of that in Q1 and almost the entire lot by Q2 of this financial year. When that happens, two things happen. We get the full margin that is coming from the customer selling price. We also have control and decision-making ability to a much greater extent to how we manage our customers. On the other side, we are buying compounds from Michelin, and till we erect the upstream equipment, mixers and calendars in the factory, which will happen by end of quarter 4 of FY27, that part of the margin will not be accessible to us. As far as the top line goes, it is subdued because we are not handling the business, as you can understand, in the transition phase. We expect a positive bump up in the second half of this financial year.
Interesting. Mr. Banerjee, thank you so much for your time today, and thank you for so candidly telling us where the next quarter is headed.
Thank you so much.
Well, 11.5% higher still for CEAT, even though the management is saying that because of the input cost price pressures, there will be significant margin pressure in the next quarter. They will, of course, be passing it on to the consumers, and they've given a definitive timeline as well as to how that pass-through is going to happen, which in turn may actually impact their demand both domestically as well as in the international markets. But no stopping CEAT, 12% higher and still counting upwards as we speak right now. Of course, this quarter's performance has been excellent by all parameters. We'll take a very quick break. We'll come back and we'll discuss oil markets and where they're headed next.